Yesterday, Friday, April 19th, was a strange day in the stock market. The Dow Jones Industrial Average gained 211 points or 0.5%, and the NASDAQ was down 319.49 points or 2.05%. The Russell 2000 small caps eked out a gain of 0.24%, while the S&P 500 declined 45.5 points or 0.9%. This oddness was driven by major declines in several stocks that had largely propelled the major stock indexes, the NASDAQ 100 and the S&P 500, up so far this year. An example is a $84.71 decline or 10% in NVIDIA, which closed at 762. Meta platforms declined $20.73 or 4.13%. Amazon closed down 2.56%. I describe that kind of action as too many of the thundering herd moving toward the exit at the same time. Even though my stock weighting is close to 12% of my total portfolio value, the stock portions of my Fidelity and Schwab accounts were up by more than $1,000 yesterday. I did not check my Interactive Brokers and Vanguard accounts, but they were probably up as well. The reason was that the higher dividend-paying stocks rose in value yesterday. One of the utility ETFs, symbol XLU, closed up 1.54%, and equity REIT ETF, symbol VNQ, was up 0.48%. The consensus last quarter was that the Fed would cut the federal funds rate by 75 basis points before year end, which was a prediction that was made by majority, not all, of the Fed members in the March projection materials. The market is no longer expecting cuts of that magnitude because of inflation. Even the federal funds contracts, which have been more optimistic about rate cuts than the forecast embodied in the Treasury bill yields, now has the more probable than not scenario at 52.1%, as only one rate cut on or before the December 2024 meeting, with a 15.8% probability of no rate cut at all, which was just 0.5% a month ago. Those numbers can be found at the CME FedWatch tool. The last 3 months have shown an acceleration of inflation, which, if continued, would put a rate hike back on the table. The increase in interest rates are negatively impacting corporate profits for a large number of companies, particularly those who benefited from variable rate loans priced at spreads to short-term rates when the federal funds rate was near zero. So they benefited from that. But they are now having to pay 6 to 8%, depending on the credit risk of the company. Every company that sold bonds when interest rates were abnormally low, and they were abnormally low for a very long period, are having to refinance upon maturities of those bonds at significantly higher rates. So this is squeezing profits, and the amount of squeeze depends on the percentage use of variable rate debt to fixed rate debt, and how much of the fixed rate debt was locked up longer term at abnormally low rates. From a long-term historical point of view, and I do have a long historical viewpoint here, there's nothing really that abnormal about the current interest rate environment. but the psychological impact is negative given the extremely long time that interest rates were extremely low by historical standards and even low for the Great Depression standard. I published my weekly blog yesterday discussing in that post purchases of $29,000 in principal amount of short-term investment grade corporate bonds and treasury bills. I did add to my dividend paying stocks some, not in a measurable amount, by approximately $1,600, which reflects my conservative investing approach. In my next post, which will be published next Friday, I'm already up to discussing $16,000 in principal amount of investment grade bond purchases, including $4,000 in principal amount of first mortgage bonds. The dividend stock purchases are currently near $300, so that pretty much tells you where my head is at right now. I will probably cut off the corporate bond purchases with the ones made up to last Friday. I do not require much of a spread to treasury yields for first mortgage bonds issued by operating subsidiaries of electric utility companies. I own a number of them. One that will discuss in my next post is a 3.25% coupon first mortgage bond that matures on 12/1/2025, issued by an operating subsidiary of Evergy, EVERGY, that I bought at a total cost of 96.479. The yield to maturity at that total cost is 5.5%. The YTM, the yield to maturity, adds the profit realized at maturity to the coupon to arrive at a total yield number. Based on yesterday's closing yields, the one-year Treasury bill was at 5.17% with the two-year note at 4.97%. So far, I have decided to and have entered orders for the 6-month Treasury bill auction and the 2-year Treasury note auction, which will be next Tuesday.